Hello there.
Hello everyone, so lovely to see you all again. I'm the Gentleman Investor. This is Battle 5. Let's invest. As always, we're going to reveal who won the battle between last week's REITs. We're going to have a portfolio update, and we're going to discuss this week's battle stocks. Without further delay, let's get underway. Triple Point Social Housing and Impact Healthcare battled it out last week. We've added up all the votes, and the winner was... What was the winner? Triple Point Social Housing. Yay! Here's a quick reminder about how our investment portfolios are arranged. Every week we invest £25 into 3 portfolios. That amount goes up as we get more subscribers. The first portfolio is the Battle Royale, where we invest in the winner of 2 stocks that get pitted against each other each week. The second portfolio is the Benchmark, which is how we measure the performance of the Battle Royale. Each week the £25 goes into the same fund, the Vanguard FTSE All World. It measures the market, and so we can get an accurate representation of how the Battle Royale is performing. The final portfolio is the Income Generator. The sole purpose of this portfolio is to make money, and we're going to pay it out to a lucky subscriber every 6 months. And that's it. So, how are they doing? Our current subscriber count is still 2, so that's £25 into each of our 3 portfolios this week. Let's see how they've done. The first is the Benchmark, holding the Vanguard FTSE All World. It is currently up 0.97% on the week. Happy with that, thank you very much. Next up is the Battle Royale, which now holds 4 stocks thanks to the addition of Soho. It is up 0.2% on the week, but somehow we've managed to lose 0.6% so far. Fortunately, Tesla is still going strong for us at 4.2% in the last 7 days, and a massive 19% up overall. Thank you, Tesla. Here are the 4, nothing too exciting, you know who's won. And looking at the last 3 sets of investments, we were ahead initially, then we went up to £76 in total value, still comfortably beating the market, and the latest one this week's, the market has suddenly overtaken us. That's the GB market. We're up 0.9%, which I will still take, and the market is up 4.1% this week. Last week, the GB market did terribly, minus 3.2%, and our Income Generator did all right on 0.2%. This week, a similar story where we've beaten the market. It went down by 0.5% and we're up a whole 0.03%. We're at a total value now of 100, which is fantastic. We can look forward to a next payment of 60p and the next winnings of £1.15. Last week, our annual dividends were £2.36 and we're jumping up to £3.13, so I'm quite excited about that. A yield of 3.11%. The big question, how do they all compare to each other? Last week, the Battle Royale was comfortably ahead, 3.15% overall. Let's see if this week competes. It does. Battle Royale still comfortably winning, gone up from 3.15 to 3.78%. The Benchmark happily ticking along in the right direction, less than 1% now, 0.92%, and the Income Generator earning us income and not growth. But very happy, all in the green, can't ask for more than that.
3, 2, 1, fight!
This week's theme is UK retail. Why UK retail? Well, I'm hoping that as rates come down, pressures on consumers ease and retail as a whole goes up. I've narrowed it down to B&M, ticker BME, and Next, ticker NXT. We also considered WH Smith and Marks & Spencer's, but to oversimplify matters, they're simply Wall Street snowflakes were a little bit too orange for me at the moment. So, how do Next and B&M look overall? Let's take a look at Next first. It is quite a large company with a market cap of 11.7 billion. It's got a PE ratio of 14.76, which for the UK market is neither massive nor tiny, I would say. It's got a very handy dividend yield of 2.12% and an earnings per share of £6.62. According to Simply Wall Street Snowflake Analysis, it is defined as having an outstanding track record with an excellent balance sheet and pays a dividend. The only slight concern I would highlight is that they don't think too much of its future prospects. Looking at B&M, it's a slightly smaller company with a market cap of 4.16 billion, although with those numbers that's not something to be massively concerned about necessarily. It's got a PE ratio of 7.56%, and yes, that looks on the lower side, certainly compared to Next, but that's not always necessarily a good thing. For example, if a stock is plummeting, you don't necessarily want to be catching a falling knife. However, if it's good value, it's just good value. Looking at the underlying fundamentals. And looking at BME, it's at the low end of its price range looking at the 52-week range. And is that for a good reason, or is that just meaning that it's a good entry point? That is the question we need to ask. It pays a massive dividend yield of 8.36%. Again, not always a good thing if a stock's paying high dividend has a high dividend yield and is potentially not trading so well. On the other hand, if it's got a solid history and is in a healthy financial position, 8.36% is a lovely dividend to have. It's got a small earnings per share, certainly compared to Next, of 0.37, so also worth bearing in mind. And there's not a huge amount in between these two. Looking at its portfolio snowflake, it's classified as an undervalued established dividend payer. So Simply Wall Street don't seem to be too worried about its health. Particularly looking at this chart, its health is still in the green, its past is okay, but its dividend is great and its value is good. They also don't think too much about its future prospects, which we should be worried about. We shouldn't be investing in anything that we don't think is going anywhere. But I do hope that looking at the macroeconomic factors and hopefully the pressure easing on consumers, hopefully these sort of retailers will start to pick up in the near term. Whether we should go for budget retailers or we can start looking towards the higher end of things is a better question to be asking. But either way, I think these are good companies and, as I say, not much to choose between them.
So all things considered, both seem to be stable companies with decent future prospects. So it was a pretty close call. But in the end, I suggest we invest in B&M. B&M is trading further undervalued compared to Next on Simply Wall Street, whilst at the same time having a higher future growth earnings forecast. It's currently trading at a 52-week low. So am I missing something, or is this a good time to invest? Please let me know what you think. Do you agree, or do you think we should be investing in Next or another UK retailer? Please let me know in the comments. Thank you so much for watching, everyone. See you next week.
Goodbye.